The following script was written, verified, and approved by compliance professionals at financial regulation courses. A dividend is a distribution of property made by a corporation to its shareholders out of earnings and profits, as defined by IRC Section 316 and codified at 26 U.S.C. Section 316. Whether in cash, shares, or property, it represents the mechanism through which a corporation returns profits. The tax treatment is consequential. Qualified dividends meeting source requirements are taxed at preferential long-term capital gains rates. Ordinary dividends failing these criteria are taxed at marginal rates up to 37%. This regulatory framework involves SEC Rule 10b-17 and FINRA Rule 1114-0, making mechanics a cross-disciplinary subject for SIE and Series 7 candidates. Under IRC Section 316, a dividend means any distribution out of earnings and profits accumulated after February 28, 1913. This E&P concept represents the economic capacity of a corporation to pay dividends from taxable income. Distributions exceeding earnings and profits are not dividends for tax purposes. The excess is treated as a return of capital, reducing the shareholder's cost basis, while amounts exceeding basis are treated as capital gains. 4 dates define the life cycle: declaration, ex-dividend, record, and payment. Under the T+1 settlement cycle implemented May 28, 2024, the ex-dividend date is now the same day as the record date. A buyer on or after the ex-date will not settle in time to appear as a shareholder of record. For standard dividends, this is determined by FINRA Rule 11140B1. The stock price typically declines by the dividend amount on this date. For qualified treatment under IRC Section 1H11, common stock must be held for more than 60 days during the 121-day period beginning 60 days before the ex-dividend date. For preferred stock, the requirement is extended to more than 90 days during the 181-day period. Failure to meet these thresholds converts the dividend from qualified to ordinary. Several categories are explicitly excluded from qualified treatment, including dividends from REITs, MLPs, and money market funds. REIT dividends are taxed as ordinary income because they are pass-through entities. However, individual investors may deduct 20% of qualified REIT dividends under Section 199A, reducing the effective maximum marginal rate to approximately 29.6% for eligible taxpayers. SEC Rule 10b-17 requires that any issuer of publicly traded securities provide notice to FINRA or the relevant exchange at least 10 calendar days prior to the record date for any distribution. REITs must also satisfy the distribution requirement of IRC Section 857, distributing at least 90% of their taxable income annually to maintain their tax-advantaged status. Share repurchases, governed by SEC Rule 10b-18, offer a safe harbor for corporations returning capital. Unlike dividends, repurchases only trigger tax consequences for the selling shareholder, allowing others to defer capital gains. Dividend reinvestment plans, or DRIPs, allow automatic reinvestment. Notably, these are still taxable in the year paid. The reinvested amount becomes the cost basis of newly acquired shares, requiring careful tracking for capital gains. In summary, dividends are a complex intersection of corporate law and tax strategy. Candidates must master the IRC definitions, the 4 key dates under T+1, and the specific qualified dividend holding periods. Visit financialregulationcourses.com to access one of the industry's fastest-growing free finance dictionaries, expert career resources, and innovative professional memberships. Learn how our verified professional profiles, QR code resumes, and intelligent career technology are helping finance professionals present themselves with greater credibility throughout the hiring process. Thank you for choosing Financial Regulation Courses. Elevate your professional standing and command of regulatory mechanics today.